The following is a presentation of TFNN. Trade what you see with Larry Pesavento. Call now, toll free at 1-877-927-6648 or internationally at 727-445-1044. Now, Larry Pesavento.
Okay, looking good, Billy Ray. Feeling good, Lewis. Welcome to January the 14th. Boys and girls, a week from today is a market holiday, so we will not be on. And Friday, I will not be in the office. I have the old medical time of the year when the old people have to go in for their checkups and stuff. And that's what I'll be doing on Friday. Okay, let's take a quick look here at the German DAX. As you can see, we completed a really nice ABCD to the upside, started a little bit lower. And if we take a look at the FTSE, you were seeing the same thing, and it's starting to move down a little bit. We had multiple ABCDs on that 4-hour chart on the FTSE, so that was very important. Those of you that received the newsletter, you'll notice that we talked about there's a huge divergence going on in the E-mini futures contracts. We made perfect ABCD patterns in the NASDAQ. That was just spot on, ABCD, right at the 61% retracement. We also did it in the IWM. It was spot on at a 61% retracement. But the Dow Jones Industrial Average and the E-mini S&P both missed it by a little bit. That's why we suggested in a video last night that if we gap down in the S&P on Sunday night, it was probably indication, a forerunner of weaker prices for the day, and that's exactly what happened. We opened about 5 lower in the S&P on Sunday night, and it went down to be about 22 lower. We've rallied back a little bit since that level, but it gives a negative bias to it as what we're watching, or at least here from early this morning. There should be some pretty strong resistance, I believe, at around that 2580 level in the S&P, because that's where we broke down from. And now we'll see what's happening with this on a little bit longer time frame. By the way, David White has just posted some other things from the book Reminiscences of a Stock Operator by Jesse Livermore. Edwin Lefevre was the pen name used by Jesse Livermore, and it's just really amazing how adapting these quotes are from Livermore's book into trading, because David's post today is a successful trader must fight two deep-seated instincts. He must reverse on what he calls his natural impulses. Instead of hoping, he must fear. Instead of fearing, he must hope. He must fear his loss may develop into a much bigger loss, and he hopes that his profit will become much bigger with a bigger profit. That's true. That was one of the things that led me to name the book Trade What You See, Not What You Think, because it's the patterns that you're looking at that's really controlling it. Your thoughts are the things that get in your way. And remember, when you look in the mirror, you're looking at the person that is the most responsible for your trading, and so you have to take responsibility for that. So remember, keep your losses small, and then you'll be a lot better. But you can't keep them too small. That's the problem is, some people, in fact, when Mark Douglas did his work on his first book, The Disciplined Trader, he had over 10,000 customers that he looked at through Merrill Lynch. And it was really amazing to see that the main two reasons why people lose is they, A, trade too often, and B, they put their stops too close. That was the main thing, and that leads to that statistic that about 85% of new traders will lose. Those of you that stick with it over a period of years are going to make it, because you stop making those silly errors, you stop over trading, you stop putting your stops a little too close. And what I mean by a little too close, if you're trading foreign exchange and you're trying to trade with a 10 pip or $100 loss, I mean, forget it. The market will react around those numbers like they don't even exist. So And what I mean by that is it'll go up and hit it and come right back down again. So you've got to have a program that gives you an acceptable, and what I call an acceptable risk. And usually somewhere around $400 is about the most you have to risk when you're trading foreign exchange. And in the S&P, with the volatility we're having now, you've got to move your stop up probably to around 12 points, which is around $600. It used to be 400, but with the volatility right now, it certainly looks like you got to expand that to the downside. Now, there was a little chatter this morning here in the TFNN room about the Treasury bonds, and I think it's important that we take a look here at the German Bund. This is the equivalent to our 30-year bond. This is a little bit longer time frame, and you'll notice here that this is a daily. You'll see we had a beautiful butterfly pattern right up there at that 1.618. We made a little bit of early test of that this morning. That's what we were trying to do in our Treasury bond for the US's, to try to get it up around that 116.15 level. We only got as high as 116.08 overnight, and that tells us that we probably are looking for higher interest rates at least the beginning of the week. Whether it's going to be towards the end of the week or not, we'll have to wait and see. But it does have a slight bearish bias as we come in here this morning. And as you remember, when we had our good friend Bill Meridian on last Friday, and we were talking about some of these things, and if you remember, he told us about this long-term cycle, and I'll bring this up for the Treasury notes. And you'll see that we're supposed to be topping here in late December, early January, and that's pretty much what's happened to that. Because if we look at the price of the Treasury notes, you're going to see that it seems like, at least from the last move that we've seen, we had a very nice rally in a bear market. You can see we rallied up to a little above the 50% level in the Treasury notes. It's an equal rally from what we had during 2017. This took 12 weeks to get up here, just about 3 months from September into January, so that should fulfill the time factor on this. So it appears to me this is a downward moving market. We had a head and shoulders pattern during 2015 through 2017. Is about as beautiful symmetry as you could get. The rally came right back to a 382 in September of 2017, and then we started lower. So this is a bear market. Remember, when the notes were making a high up there in 2016, Treasury bonds were sharply higher. They were much higher than they were in 2012, but we didn't get that type of move in the Treasury notes. That was another reason to think that would happen. Here's the long-term weekly on the Treasury bonds, and you'll see the big divergence. You'll see the, you can forget about the boat, Maria. Folks, the reason why I'm laughing is many years ago, about 4 years ago, when bonds were topping, I'm showing the chart up here right now. There was a joke with Tom O'Brien about the, it was a little friendly wager that I don't like boats, as most of you know, or ships. And Tom said that if the bonds got above a certain price, that I had to take a ride in the boat. Well, I did go out in the boat for a ride, and that was a full moon. And let me tell you, we were in the inland. We weren't even out on the high seas there in Mexico. And I have a witness, because one of the traders in the den, Mark P., was with us that day, and he'll remember that day. It was a full moon, and believe me, we got in that boat and headed out to a restaurant, and the waves were going over oh my gosh, they must have been 10, 12-foot waves that day. It was terrible. 877-927-6648.
The TAS Profile Scanner is the most revolutionary piece of trading software that you will ever try. Wouldn't you like to approach the markets with confidence? As you begin your trading day, it's likely that you'll be faced with lots of decisions. In order to make the best decision, the first thing you'll need is a strategy that will help you minimize your risks. Whether we're in a bull or bear market, a good strategy is to have the tools needed to help you scan and analyze the markets before you trade. The TAS Profile Scanner instantly scans and filters over 2,500 global financial markets, such as stocks, ETFs, commodity futures, and Forex. Headed by Steve Dahl, president of TAS Market Profile, the TAS Profile Scanner understands that in today's technological world, the use of top-flight software applications, automated trading algorithms, and technical analysis expertise is essential to successful trading in today's market. Whether you're looking at the trade matrix, the ETF heat grid, the market breadth, the landscape charts, or the many other features of the TAS Profile Scanner, this is a piece of software that will revolutionize how you look at the markets and set up your trades. The team at TAS has even put together a 12-part video series to walk you through every aspect of the TAS Profile Scanner, which you can find directly on the TAS order page at TFNN.com. Sign up now for only $97 a month with a risk-free 30-day trial, so you have nothing to lose and everything to gain. See for yourself how you can harness the full power of the TAS Profile Scanner by visiting the front page of TFNN.com today, and you'll find the TAS Profile Scanner under the Services section. Remember, with a 30-day money-back guarantee, you have nothing to lose. Don't let another day pass you by without trying out this amazing piece of software that will revolutionize how you look at the market and how you place trades. Sign up today.
Many of our new listeners have heard about the Tiger's Den. The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of the TFNN shows, plus see all of the charts as they happen live and have access to archives of all of those charts. You can test drive the Tiger's Den absolutely free for 30 days and greatly enrich your knowledge of these markets and how to make your money work for you. Details on the Tiger's Den are on the front page of TFNN.com.
TFNN has launched our brand new website. You can still visit us at the same TFNN.com URL, but when you do, you'll see a new and improved homepage with a much simpler navigation, whether you're watching Tiger TV live in high definition or just accessing your newsletter subscriptions. We even have new pricing in 6 months and yearly options. Check out the new TFNN.com now and experience all the upgrades. TFNN.com, educating investors.
Call now, toll free at 1-877-927-6648. Internationally at 727-873-7618.
Okay, we're back, folks, and I posted a chart from our good friend Mr. Z in the Trading Den because he was alerting us to the fact that we were at a real critical level in the natural gas, and as you can see here from the chart that he posted, it was a huge gap up. That was one of the things that we were looking at in this week's futures letter. I'll bring it up here to show you. It was exactly pretty much the same thing here. Hold on. Oh, wait, well, this is the best I can do. I'll put it up here so you can see this is the same chart that Mr. Z was looking at because we closed at $3.15. We opened at $3.36. That's up, 20 handles, which is $2,000, and it went up and filled that gap. That's the thing that we were watching here, is the fact that it filled that gap absolutely perfectly. So this tells us that there might be a major bottom here in the natural gas. So we need to pay very, very close attention to it. So let's watch that one down the road. This is the pork bellies of the futures market, folks. It's taken the place of bellies. Bellies used to be but those of you that don't know, the belly of the hog is bacon. That's what you were talking about when you were talking about pork bellies. As you remember from the movie Trading Places, he talked about bacon and eggs, and he said, you guys are nothing but bookies, and that's pretty much what it was. Anyway, let's go on and take a look at a couple other things that we're paying attention to. And one of the things I wanted to go is to take you down to memory lane, folks. This was brought to my attention by my good friend, Mr. Rich Anderson, over the weekend, and I wanted to just bring this to your attention. Let's go back here to 1975. If you'll notice, this is a monthly chart, so you can see between late 1975 and early 1976, the soybean oil market was setting at a level of about 13 cents a pound, and there was no demand for it at all. Things were just really, really bad in the soybean complex, and yet my two mentors, Dave Nelson from Market Research, and Oscar McClure, a private soybean trader for many, many years, who knew Arthur Cutton, and he knew George Baer, and he knew W.D. Gann, and they were very, very instrumental in looking at the price of soybeans for the coming year. Remember, folks, this was 1975 when no one was talking about the El Nino currents, which help control the atmosphere for water and stuff during our growing seasons. And it meant that the anchovies, which was used for soybean, they were used as a substitute to soybean meal, were not bringing in the same amount of crops that they were for the anchovies. So this was supposed to be a big move. Well, I was really looking at these spreads between July and December soybean oil. They were at full carrying charges. What that means is that you could have if you went long July oil and short December oil, it was impossible to lose because it was at a full carry. In other words, all the interest was included in it, and also the cost of storage and everything was, so there was just no way you could lose. The only thing you'd lose was the commission. At that time, it was like $40 to put a contract on. Now it's $5, so you can see the difference. Well, I had talked to everybody that I could talk to about buying soybean oil down there at 13 bucks, soybean oil at $13 a pound. And it had a heck of a rally. As you can see, I sold that in June of 1976. We were in them about 5 months. That tiny little move there was worth a whole lot. And then you can see here there was a big sell-off right after that. And on August 15th of that same year, I was approached by Drexel Burnham to go to work for them in California. I did. And that was a big change in my life, one of the best times I've ever had in this business from 76 through 1982. I bring this to your attention, and I bring this to your attention because, folks, we have something very, very similar going on, and we got to pay very, very close attention to it because there's a really good chance here that we could have one heck of a move. Let me bring up this soybean oil market. We'll take a look at it here. You can see here, fact is, this goes only back to 1996. I'm talking 45 years ago when we were in that oil, and that was at 13 bucks, I believe, a pound. And here we are at 28.41. We've only doubled in price in 45 years, which not many things have been that quiet. But the key to looking at this chart, folks, and this is very, very important, and I'm going to do a special webinar on this for my 24/7 subscribers because I'm working on a plan right now with some folks from Sylvia's Financial, and all that's Simon Only, and also Rich Anderson, the semi-retired from Anderson Capital Management. And we're looking at soybean oil, soybean meal, and soybeans. And they're very low right now on a relative basis. And as you can see here, the soybean oil has been low here since it topped in 2012. We've been down for 5 years. Folks, you can go back to when they first started trading grains way back in the early 1900s, and you'll not find a period where we've gone 5 years, this is the 5th year, without some type of a major crop scare. And believe me, we haven't had one. The last one we had was in 2012. That's 5 years ago. This is the longest period that this has happened. So this makes this an outlier event. The second thing that makes it interesting is this is going to be a relatively low area for buying. In other words, the risk here is going to be relatively small. Now, we haven't seen the trigger yet. There's going to be a trigger that say, hey, this thing is starting. Now, when you start looking at weather reports, the stuff that you see on the Weather Channel, that's not what you need. You need long-term, sophisticated reports that we get from certain folks that spend thousands of dollars a month just getting these reports. They're almost like government reports that are not published, but they give you a long-term perspective of what these ocean currents could be doing, and that's one of the things that we want to, keep in mind. But here again, we're down to the point where it says trade what you see, not what you think. But this is something on the table for 2019. It's starting out pretty interesting. We're looking at the same thing occurring possibly in corn and also in wheat, but the real focus will be on the soybean complex because soybeans have an inelastic demand. In other words, no matter what price you get soybeans at, there is going to be a demand for it. And remember, we have 1.5 million people in China that need our beans and oil and meal, and we have 1.7 billion in India that needs our beans, oil, and meal. And so all these integrated crops when they happen, these currents, these El Nino currents, they affect everything. So we're going to be watching this really closely. Again, it's trade what you see, not what you think. So you have to wait for everything to line up so that it's just about as perfect as you can possibly get. So we'll be in 1960, I believe the high on beans had not been any higher than $4.50. And that's the that was per bushel, $4.50. But then in 1972, we had the Russian grain robbery, and beans went from $3.50 to $12.90. That was the biggest move. That made a lot of people. Ricky the Rocket Barnes, who was a broker at McCulloch Oil Building when I was there back in the late '60s. That's the one that made him, several $100 million, and now he owns his own exchanges and everything. Yes, there are supply-demand curves for beans. Rich Anderson follows those very, very closely. In fact, I'll post one here when we're done. I'll be right back. 877-927-6648.
Larry Pesavento has just started his brand new service, Fibonacci 24/7, and he's already delivering content to his subscribers on a daily basis when the market's opened and even on weekends. Each Monday, you'll receive Larry's written report that provides detailed commentary and a summary on the charts and videos that Larry sends out. And throughout the week, when warranted, Larry will send out via charts or videos or both the key markets that he is watching during the day. This will be up-to-the-date, active trading information that will help you in your daily trading. In Larry's first week alone, he sent out 25 charts, 6 videos, and a full report to his subscribers in just 1 week. If you're a technical trader that uses patterns and retracements to trade, then Larry's service Fibonacci 24/7 is something that you must try. Right now, new subscribers can get a full 30-day money-back guarantee. With nothing to risk, sign up now to Larry Pesavento's Fibonacci 24/7 by visiting the front page of TFNN.com under Trading Newsletters. The Path of Least Resistance is David White's daily trading newsletter, and if you're looking for active trading ideas, then now's a perfect time for a 30-day free trial to this powerful daily trading advisory service. David uses his years of trading experience to offer his subscribers his trading ideas each morning in his Path of Least Resistance newsletter. Using a combination of equity trades along with options, David keeps his subscribers up to date with all pertinent market information with intraday afternoon updates when warranted. Don't miss out on this great chance to get a 30-day free trial to David's daily newsletter, The Path of Least Resistance, with no obligation to pay anything. David has been delivering solid recommendations for his subscribers recently, and if you'd like to see the type of newsletter he delivers every morning, then visit the front page of TFNN and you'll find the Path of Least Resistance under Trading Newsletters. For all the details and to start your 30-day free trial today, log on to TFNN.com now. TFNN is excited about our new software charting program, The Art of Timing the Trade Charts. In collaboration with Tom O'Brien and using his best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System, David White has programmed an outstanding piece of software that will complement any trader's methodology. Using this first-of-its-kind program, The Art of Timing the Trade Charts allows you to scan thousands of stocks for Fibonacci formation setups, including Gartleys, ABCs, butterflies, and much more. The Art of Timing the Trade Charts is designed to help you when scouring the markets for stocks just beginning to form the trading patterns that many investors spend days, weeks, or even months searching to find. And right now, we're offering licenses available at only $79 a month. We are so confident that you're going to love this new charting software that will even give you a 30-day unconditional money-back guarantee. Don't miss out on this incredible new piece of software. Get your copy of The Art of Timing the Trade Charts today by visiting TFNN.com.
This segment is brought to you by Think or Swim. For more information, just click the Think or Swim banner on the front page of TFNN.com.
Okay, folks, we're talking a little bit about the soybean market and what might happen. I posted a chart here about the soybeans inspected for export. This is something that they follow weekly to see just how the the crop is being disseminated. Remember now, our crop is in the bin right now. There's nothing growing. We're going to have planting intentions coming out here in about another 6 or 7 weeks on how much they're going to plant. But if you notice here, that red line is what the expected exports are for 2018 and 2019. Folks, this has nothing to do with what I'm looking at. I don't look at this particular thing except maybe once a week, because as you can see from that red line, they are actually behind on exports that we had for 2016 and 2016, 17, and 18. So the crop year for 18-19 has started small. Well, duh. Why do you think it is? Because China stopped buying for a while. They're still in there buying. As you can see, it's still going up. If that red line ever turned down, that would be something that would be very, very important to the farmers. But it's not. Right now, the sales are less, and that's because they're playing economic games. That's really what it's all about. My opinion, but these are the types of things that fundamental people look at. Now, I'm watching the price action, because that's what makes the thing, move. Trade what you see, not what you think. Thinking is what gets you in trouble, and that's not one of the things that we're doing. Yes, but there is a way to track that. And if that red line really starts to accelerate, where are you going to see it first, folks? You're going to see it in the price market, because the farmers will be, they'll be bidding up prices at the grain elevators to take care of these exports, and then prices will go higher. So it's a self-fulfilling prophecy. So that's what we're watching. We're trying to put all this together to see how we fit it together. Now, whether that's going to happen or not, I'm not really sure. But the good part about this, boys and girls, nobody else is either. That's the key. Nobody really knows what's going to happen. These are assumptions, and you know how you spell assumption? A-S-S-U-M-E. So pay close attention. Now, we have something going on exciting here, because I am hearing my limit minder go off, and it's telling me we're starting to weaken here in the S&P, which is pretty much what we were expecting this morning. I will post what the prediction was for this morning. I don't know if it's going to mean anything or not, but we'll do this one more time here. This is the AI program that I'm looking at, and we were looking for the market to weaken right around the open, and that's what's happened so far, but it's still a little bit early to look at. Folks, let me give me my 2 cents worth here on the overall market. Longer term, we made such an important bottom down there in that in the NASDAQ. Larry. Judge's ruling. Let's call it the New York Stock Exchange Index. You'll see that low last week in December. That was a perfect 62% retracement of the whole move down. That's extremely important. We had an explosive 3-week market move to the upside. We completed the ABCD of that move in the NASDAQ, and also in the Russell, and also the New York Stock Exchange Index, but we did not complete it in the S&P. It should have come in at around 2610. We only got as high as 2599.50. We're now trading 27 handles under that, so that's a possibility that we're going to have some type of correction in here. Now, someone's asked the question is, what does this look like long term? Folks, long term is way past my pay grade. I do pretty good on hourly charts and daily charts. When you start getting out into weekly charts, it's a little more difficult. But what you can do is you can look at overall support and resistance. And you must, if you're going to look at the economy, you got to look at everything on a global basis. So let's just take a quick look here at, and this is actually a very constructive chart. This is the emerging markets. Now, we brought this to your attention, way back in October, that we were setting exactly at that 61% retracement, and also the 50% retracement of 2016. And that was an extremely important one. What did we do 3.5 weeks ago? We went right back and tested that low again, and we've had a pretty good move, and that's the emerging markets. Now, if we take a look at what China is doing, and that's a big factor in all the things that we're watching here. Let's just get the Chinese market up here. Here it is. Just a second. This is the Chinese market, the ETF, and this is the really a big one, because this is the large cap, Chinese. This has all the big banks in it, all the other stuff that they look at. And here again, you're looking at the same pattern, different ratios, because this has been much weaker, but you stopped right at the 78% level from the low in 2017 at the exact 61% retracement of the low in 2016, and you did a double bottom. And look what happened. Bada bing, bada boom, it came out of here like a rocket. That's why if we go below those levels, trouble in River City. And that's where you don't want to be. But that's what we're watching longer term. You know, that's my 2 cents worth as far as the mathematics. It's just simple A, B, C, D, and ratios. And when you try to look at the over economy, I look at just, you know, big things. Here's one on because I've always talked about here that the big problem, what we have in the markets, is not so much stock market stuff. It's related to the debt that's out there. I'm talking about, you know, student debt, consumer loan debt, auto loan debt, mortgage debt, all that stuff. And this shows the ratio, the fact that we're up here in areas that we've not seen here in the last 30 years, where our ratio of corporate debt, you know, to the GDP is at a really extreme level. And since I like patterns, and I do like patterns, you can see that beautiful 3-drive pattern that is setting there. Look at the highs that occurred in 1990. What led to that? A recession. Look at 2000. What happened there is recession. Look at 2008. What happened there? It's a recession. And you have a 3-drive pattern on U.S. corporate debt. That's not a good pattern, folks. And just pay attention to it. You know, it might mean something. But right now, you know, we just had a, you know, really big test here on December 26th, and now we're having a tremendous move. And if you remember, when we were looking at this, the key to the whole thing of the market going down from October through December was the banking index, because it was acting so badly. It actually topped in 2018 very early, and then we had the big drop down, and that was a really key one, folks. When we hit that Christmas last week of December, we hit the exact 382 retracement of the low going all the way back to 2009, and it was also a perfect 61% retracement from the low in 2016, and that's a big deal. So that's what we're paying attention here. Now, we got a question here about our Mr. POTUS, El Presidente, and that is, I don't understand the politics of going. I try to watch it as little as possible. All I know is, you know, Mr. Bill Meridian and also Tim Bost both feel that the astrological charts for Mr. Trump does not show anything like it did for Nixon as far as an impeachment or anything like that. But, you know, what you hear and what you see is a whole different ball game out there, folks. So trade what you see, not what you think and not what you hear, because it's those prices on the charts that make you look very interesting. So that's the main thing of keeping a close eye on this. We weakened a little bit early this morning, but we'll see how it ends up for the day. But that's what we're taking a look at. When we come back, we're going to take a quick look at one particular commodity that we're watching very, very closely, and that is sugar, the sweet. 877-927-6648.
Hi folks, this is Tom O'Brien. If you'd like to be the bank and get the type of interest they receive instead of the low interest rates they give to clients, then I have an investment you may want to take a look at. I'm offering 4-year secured first mortgages on buildable city lots in St. Petersburg, Florida. The investment can be anywhere from $30,000 to $75,000 per buildable city lot. The interest paid is 7% per year, paid monthly. Depending on the investment, the income per month per lot ranged from $175 for a $30,000 investment to $437.50 for a $75,000 investment. If you are in the CD market, you want to look at this investment. St. Petersburg is located in Pinellas County, which is the densest county in Florida. If you're looking for an investment with your principal intact that pays a good interest rate, this may be for you. The supply is limited, so act now. For more information on these secured first mortgage opportunities, you can call me at 877-518-9190. That's 877-518-9190. 9190.
No matter what kind of trader you are, 2018 is a great time to try out a subscription to Tom O'Brien's Gold Report. Whether you just plan on diversifying your portfolio with some exposure to gold and gold mining equities, or you're a gold bull that sees 2018 as the year of commodities, now is a great time to sign up for the Gold Report. Tom O'Brien publishes his Gold Report every Monday morning before the market opens and covers a variety of topics including gold, silver, platinum, copper, the XAU and HUI, the dollar, bonds, South African rand, as well as more than 20 of the most actively traded mining equities. Start your 2018 off with a bang and sign up for the Gold Report today. The Gold Report is a long-term newsletter where the focus is on building real wealth through the management of a successful portfolio of gold stocks. For all the details and to start your subscription right now, visit the front page of TFNN.com and you'll find the Gold Report under Investment Newsletters. Will the S&P 500 continue to climb? For bold trades on U.S. large-cap stocks in either direction, trade SPXL, SPUU, or SPXS. Directions Daily S&P 500 Bull and Bear Leveraged ETFs. Direction Leveraged ETFs. An investor should carefully consider a fund's investment objective, risks, charges, and expenses before investing. A fund's prospectus and summary prospectus contain this and other information about Direction shares. To obtain a fund's prospectus and summary prospectus, call 866-476-7523 or visit directioninvestments.com. A fund's prospectus and summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors. Distributor Foreside Fund Services, LLC.
The Bull Bear Binary Option Hour. Next on TFNN.
Okay, we're back, folks, and we're talking with Mr. Z, John from Philadelphia. John, how are you doing?
I am doing very good, and thanks for taking the call. I wanted to ask you this morning if you could bring up a little bit of your historical experience regarding the COMEX gold market, please.
Sure. I posted the chart going back to 1976. Ironically, you can see the gold was bottoming there in the late spring, early summer of 1976. I went to work for Drexel Burnham on the 15th of August of that year, and they immediately gave me 50 commodity accounts, just corporate, in-house accounts to start trading for, and I started buying gold. Now this was 4 years after Nixon took us off the gold standard in '72, and the gold was trading around 130 an ounce. And as you can see, that went straight up to 865 in January of 1980, and that was the whole thing. I mean, I just lucked out, John. I went from one from one good thing to another, and that was the whole thing. So, and now you can see that we've made a 382 retracement over the past several years. We haven't taken it out as of yet, but if we ever get above 1400, you could possibly see new highs in gold. Way above 2,500 if that happens, if we can clear 1,400.
Thanks for that. I want to draw on your experience going back into the 70s and 1980 when gold hit that peak. I think it was 878. Was it January of 1980?
January 20th, 1980, and the high, I believe, was 865. That's from my memory.
Very cool. And of course, the COMEX gold futures market was launched, I guess it was, 72 or 73, following the, August 1971, when Nixon did his speech closing the gold window. And
yes.
If not mistaken, prior to gold being traded on the commodity exchange in New York City, there was a predecessor futures market that was essentially, what's the word I'm looking for? It was kind of a starter, a test run, trading gold futures up in Winnipeg on that commodity exchange. And
yes,
Larry,
I believe you're correct. Yes,
I'll share with you. I have a nagging and week by week increasing suspicion that something akin to Bretton Woods of 1944 or the disconnecting the dollar from gold that occurred here in 1971 is on the cusp of happening, whether it's today, tomorrow, a year, or what. Of course, I don't know, but everything I see hints at something like that about to unfold. And my question is, Larry, can you give us any guidance as to what you can recommend we be prepared for as it pertains to actual trading of that COMEX contract? Is there a risk that the terms of the contracts are restructured in some way, that trading is restricted in some way? And I know you had experience in January 1980 dealing with COMEX restrictions, so I thought I'd just ask you to speak to that issue if you could.
John, that's one of the uncontrollable factors that we have in the market, and that is the fact that we are looking at a situation where the government could come in at any time, or the exchange, like we did in 1980. What they did is they restricted short selling of silver. And that basically, the shorts were, basically hung out to dry. And the problem, the longs were hung out to dry because there was no more short selling allowed on the Merc. And so what happened was the market just totally collapsed. And the reason why they did that is many of the members were already short silver and they were getting killed. So they had to change the rules. The government can do this at any time. They can do it with Bitcoin. They can do it with anything. That's one of the unknowns that we have. We don't know if that's going to happen or not, but that's what we're looking at. The factor that I'm looking at regarding some of the larger picture of control and stuff like that is looking at that U.S. banking index that we talked about, the BKX, because that has been a perfectly technical, it's the largest banks out there, not counting the Chinese banks. The five biggest banks in the world all come from China, so they're not in that index. But if we get below 80 on a closing basis in that banking index now, that's going to trigger something very, very sinister to all the markets. It means that money is getting extremely tight, and it's going to be hard to get financing. We could be looking at much higher interest rates, that type of thing. But that banking index is the key of what I'm looking at, because it stopped exactly where it should have. I mean, to the tick. So that's what we're looking at from a longer-term basis, I believe.
I appreciate that input, Larry. I'm going to hang up and thank you. But if you have time, either today or tomorrow's show, just to describe just personal experiences that you and your colleagues had out there at Drexel in January of 1980 when the exchange instituted that liquidation-only process or set of rules for COMEX gold and silver, be interested to hear just firsthand accounts of traders that either you or your colleagues, how they were either hurt or benefited by that rule change at that time. So thanks so much in advance.
I'll talk about that right now, John. As silver and gold started to move up into early January, I had been buying and selling gold for 5 years, and the move that we had, gold moved $250 an ounce between late December and January 20th of that big move. So that was a $200 move. Well, I started getting out of long positions the second week of January. The gold was trading at around 660, I believe, and we had been buying it from 130, 230, 330, and so we exited all that stuff. And so we were out of it. The reason why I waited that long is because then you didn't have to pay taxes on your gains, for 18 months. So you got it tax-free. Well, as silver started to go higher, and this is the key to it, the bags of silver were the things that many people were buying. In other words, a 1,000 face value bag was now selling. The amount of silver in it was around $50 an ounce, but the bags themselves, John, never got any higher than about $37 per ounce in silver. So there was a $13 spread there between what silver was actually being sold for at Handy and Hardham and some of the other places and where it was sold on the exchange. So something was really wrong. And that's why that whole thing came apart. And, it was mainly what's his name? What's those dudes' names down in, I can't remember. Yeah, the Hunt brother. Yeah, Lacey Hunt was down there in Dallas. And I remember his broker was Jimmy Jones. And they were clearing a lot of stuff through Drexel. And, we would hear stories about these huge margin calls that they were getting down there. And, you get a $50 or $100 million margin call, not too many people carry that much pocket change around. So that was really indicative of, boy, there's something nasty getting ready to happen here. And of course it did. Gold went from 865 down to below 400 in a matter of 4 months. So we'll be right back.
Thanks so much.
You bet, John. Thank you.
I'm certain you are or strive to be one of the best at everything you do in life. It's the most common trait that we tigers and tigresses share. If you're looking to become the best of the best when it comes to managing your money, let me teach you to do what most wealth managers tell you can't be done, which is how to time the markets. I'm Steve Rhodes, author of Mastering Probability, and for the last 12 months, Timer Digest has been tracking my newsletter signals, which have earned me the ranking as their #1 market timer in the nation for the S&P 500 for the last 12, 6, and 3 months. Timer Digest also ranks me as the #1 market timer for gold as well. The fact is, markets can be timed, and I'll teach you the exact set of tools that I use that has transformed me into one of the best at what I do. Sign up for Mastering Probability today by clicking on the newsletter tab on the homepage of TFNN.com and get immediate access to workshops where I take you step by step how to use an extraordinary set of tools as well as provide great market calls too. Sign up today.
If you haven't checked out the newsletters page of TFNN.com, what are you waiting for? All of the TFNN newsletters are informative, up-to-date, affordable, and a must-have for every trader looking to gain a competitive informational edge in today's markets. TFNN newsletters cover every aspect of the markets to offer you the very latest in market news. Plus, new subscribers get to test drive our newsletters risk-free for 30 days. From all aspects of the markets, including stocks, bonds, metals, commodities, and tech, there's a newsletter to fit your needs exclusively from TFNN. Stay informed each day you trade and get that competitive edge that will help you stay ahead of the game. Visit our newsletters page by going to TFNN.com and click the newsletters button near the top of the page. TFNN.com, educating investors.
Since 1984, Basil Chapman has been using the Chapman Wave methodology to advise traders of his expert market opinion. While originally hand-drawing charts from the late 1970s into the 1980s, Basil noticed that prices under most circumstances virtually always had a certain number of legs to the upside before declining sharply. Later, Basil found that computer software, which included the standard market technical indicators, enhanced the degree of accuracy in calling price turns, as well as market trend calls. Thus was born the Chapman Wave sequence. Using the Chapman Wave methodology along with other indicators, Basil Chapman advises his subscribers of his expert market opinion each market day with his opening call newsletter. Right now, you can get a 2-week free trial to the opening call, Basil's daily trading newsletter, by visiting the front page of TFNN.com. Cancel at any time during that trial and pay absolutely nothing. Get your 2-week free trial to Basil's newsletter, The Opening Call, today by visiting TFNN.com.
This segment is brought to you by Think or Swim. For more information, just click the Think or Swim banner on the front page of TFNN.com.
Okay, we're back, folks, and one of the things that we want to pay attention to this week is this crude oil market, because we've had a really nice 25% rally off of the bottom, And if you'll notice, we went down to just a tad below the 61% retracement of the low in 2016, and we rallied from 42 to 53. That's a 25% rally, and we're trading a little below $51 today. If we get a low down here at around 47 here this week, that would really be a nice possible ABCD pattern that would be forming with a 61% retracement. So I would watch that very, very close. Sugar the Sweet. Thank you, Ruby. I got it right here for you, darling. Hold on a second. I had it ready to go. We'll put it up here. We had this big move in sugar. We're looking for a pullback now, hopefully down around 12.20. That's down about $500. But here's another one that looks very interesting. Had really strong support within 10 cents of the exact 78% level. So sugar trades quite nicely. You don't have to risk an arm and a leg. Each tick is worth $11.25. So if it moves a penny, that's $1,125. So watch the sugar. That's got a real potential bottoming pattern in here. If we get it down near that 12.10 level in sugar, it's got a very, very strong thing. Now we've got a special guest coming here on Thursday. And remember, we have a lunar eclipse and super full moon coming in here on the 21st, where we close that day. But Norman, he calls it to the minute, Winsky, will be on the 17th of January to give us some his ideas of what we're watching. So yes, it will be a blood moon, David. Thank you very much. So we'll see what's going on. Anyway, those are some of the things that we're keeping an eye on here. So live every day in an attitude of gratitude, and may God bless, and may all your losses be small and all your profits be big. So may God bless, folks, and we will be back in the air tomorrow, and we're going to have something special again to talk to you about the livestock market.
Hi folks, Tom O'Brien here. If you'd like to get my daily newsletter, Market Insights, then now is a great time to sign up for a 30-day free trial. Every morning by 9:30, I send out my morning letter to subscribers with market commentary on a variety of markets, currencies, and commodities to keep investors up to date on the day's trading action. Included in Market Insights are specific buy and sell recommendations for stocks, ETFs, and even options, with stops and price targets included for every trade in my newsletter. If you'd like to try my newsletter risk-free for 30 days, then head over to the front page of TFNN and you'll find Market Insights under Trading Newsletters. I use my years of trading experience to bisect and dissect the market every morning and give my subscribers the most important information they need to know for the day ahead. I even issue afternoon updates for my subscribers whenever warranted with important market action. I'm always scouring the market for the next great trading opportunity. Sign up for your 30-day free trial to my daily newsletter, Market Insights, today by visiting the front page of TFNN.com. Wow! Go get them, folks.